We will get started. Good afternoon and good morning to those who are still in morning time. Thank you for joining us today for what we hope to be a really informative 25 to 30-minute discussion on designing and maximizing a cash balance plan with some of our leading experts in the industry. My name is Kate Peasy. I'm a partner and senior consultant here at Fiducian Advisors, and I co-lead our defined benefit business practice. But before we get started, I just want to hit on some housekeeping items. We'd love to hear from you throughout our discussion, so please submit your questions by using the chat feature at the bottom of your Zoom screen. I'll monitor the questions and address them after the presentations. And if we don't get to your questions, really due to time, we'll be sure to follow up with you directly. So here at Fiducian, we work with all types of clients across the country, providing investment advice as co-fiduciary. In total, we advise on $260 billion in assets, with about $2 billion of that in cash balance plan assets. So I know many folks that are joining us today are representing professional services firms across the country. We work with a number of these types of organizations, including law firms, accounting firms, physician practices, and even investment firms, which really are areas where cash balance plans are becoming increasingly popular. So I'm thrilled to have joining me today 3 individuals incredibly experienced in working with all types of cash balance plans, from starting a new plan through strategic termination. So first, my colleague Brian Carlson is managing partner in Fiducian's Chicago office. Hi, Brian. Brian leads our investment strategy across our cash balance client base and is also a member of the firm's investment committee, executive committee, capital markets team, and our discretionary committee as well. For those who know Brian, may know he's an avid golfer, but may not know this, that he has played golf since age 8 years old and yet has never had or witnessed a hole-in-one. So perhaps this is your year, Brian. Erin Cho is joining us from Washington, D.C., where she's an attorney and a partner at Mayer Brown and a member of its employment and benefits practice. Erin counsels plan sponsors on all aspects of ERISA fiduciary compliance and also represents clients in front of the Department of Labor. Dennis Wiley is a managing director within Schwab's ERISA Services Group. Dennis has been in the industry since 1994 and joins us from Ohio. He's a certified public accountant and has also earned the QPA designation. That's the Qualified Plan Administrator designation issued from the ASPPA. In his spare time, Dennis coaches and officiates volleyball. So thank you all for joining us. We plan on covering really 4 main areas today. I'll provide a very brief refresher on cash balance plans. Then Brian will hit on how cash balance plans work in general and some investment strategies for cash balance plans, followed by Erin covering legal and fiduciary considerations. And then Dennis will close out the presentation covering plan design and optimization, including what type of organizations might be great candidates for cash balance plans. Then I'll open it up to Q&A for the remaining period. So first, jumping in, what is a cash balance plan? A cash balance plan is an IRS-approved, qualified retirement plan. They've started really gaining momentum in 2014, where allowance for what's called a market rate of return design really led to an explosion of these cash balance plan adoptions, particularly by partner-led organizations like law firms. Cash balance plans technically fall under the defined benefit purview of ERISA. However, they really act much more like a DC or a 401k plan, but offering the best features of both types of these plans. So a few reasons behind the cash balance momentum, I'll say. One, they allow for significantly higher contributions than a 401k, and Dennis will touch on some of those specifics. They offer better risk controls for the plan sponsor. And I think finally are really pretty easy to understand and therefore becoming a much more powerful tool for attracting and importantly retaining top talent, particularly among professional services firms. So with that, Brian will jump in to discuss investment considerations when offering a cash balance plan. So Brian, over to you.
All right. Thanks, Kate. So I think we can all agree or maybe argue that there's a fine line in golf and the investment world between luck and skill. But one thing that I hope we can agree on is that hope in both of those is not an effective investment strategy. So as we take a look at designing these plans, knowing the way the mechanics of these cash balance plans works is of utmost importance, right? So as Kate mentioned, there's a little bit of a blending of traditional and defined contribution as far as these plans are constructed. Basically, though, what we're looking at today is starting with an account balance at the beginning of the year, or a contribution, pay credit, either percent or dollar based. This is usually designed, and Dennis will get a little more into this, by a table, and so different features and characteristics on that end. But then the investment side comes in on that interest crediting rate. So historically, a lot of these plans were built with a fixed rate or a variable rate. So fixed, like it says, flat, call it 5%. Investment crediting rate or interest crediting rate. Variable, though, more based on treasury rates, right? So there is a bit of an issue as a mismatch of asset performance versus, call it, what the liability or what the account balance grows by, right? So this year is a good example. Fixed rate, if you were giving a 5% interest crediting rates, when the market's down 5 or 10%, you have that 10 to 15% gap of asset performance versus what the account balances are growing by. Variable, very similar, right? So if you're using, for simplistic reasons, a 30-year treasury rate, right? This year, as rates have increased, that's better for your account balances. They're growing at higher rates. But if your assets are invested all in treasuries, then your assets have come down. So you have a mismatch there. A market rate, which is bolded at the bottom there, really tried to solve some of these mismatch issues. And that's where we're really going to focus most of our attention today. So unlike traditional plans, which you're trying to match up liabilities and hedge some of those risks, really within the market rate plan, it's more of an absolute return framework. Most of these are designed to be, first and foremost, tax deferred vehicles as the main benefit, but you do have that investment strategy part of it. So in the next page, we'll talk a little bit about how we start to look at those different features and characteristics of the market rate plans. Most of our clients fall into what we would call the total market approach on the left. So they're designed to try to achieve a longer term return of say 4 to 6 or 4 to 7%, somewhere in that kind of annualized framework. As I mentioned, the market rate plans, the market return of those assets is going to be your crediting rate. So if the market's up 5% or your assets are up 5%, that's your crediting rate. The one big stipulation is there are these cumulative kind of capital preservation floors. So if you go negative for in a long gated period of time, you do have the potential of having a mismatch there. But as we'll look, if these are constructed properly, that's a pretty low probability event. So total market approach is just total return objective, kind of in that 4 to 6% range. But then as plans mature, we start to look at the demographics, right? What is the age of your population? What is the distance the individuals have to the 415 max? Are any of those characteristics give us the ability to change or alter the investment strategy? All the way to the right, that's a bit of a growing trend, the individual crediting rate. You can't give participant access to move these dollars on their own, but we are seeing a bit of a growing trend of plans looking to more tailor a decision to different investment philosophies. So one approach might be to construct, say, called 3 portfolios, and at the outset, maybe you could select an aggressive, a moderate, or conservative, but then you stay there as a participant or a person within the plan, quote unquote. You could also kind of design it more like a target date kind of glide path based on age or how much distance you have to that 415 max. Kind of determines how aggressive or conservative you are. But again, that's more of the growing trend. We haven't really seen a lot of adoption there, but seen more conversations on that front. For today's discussion, we'll talk more about the total market approach, looking at the total plan assets, investing those somewhat conservatively, but looking at a return objective over time of about 4 to 6%. Once we get into that objective setting, the next is how we kind of look at the investment world as it evolves on the next page from year to year or throughout the years. So we're developing those constraints. We're constructing using our internal proprietary frontier engineer optimization that's looking at capital market assumptions and those return objectives out to a 10 or maybe even 20-year horizon if we need to go farther. Then we're systematically rebalancing those periods like this where markets are up and down and very turmoil. We want to make sure we have that systematic strategic rebalancing put in place. And then as the capital markets are revising and evolving like they do on a daily basis, we're looking at how those assumptions change more on a specific asset by asset class base there, if there are opportunities to change or alter some of the investment framework. The next page shows us a little bit of the difficulties. So most of these plans in that 4 to 6% return range, tend to have about, call it 65 or maybe down to 45% or so in fixed income. So if you look at that third bar in US core bonds, down 9.7% as the year to date, as this was printed, that's been a challenging environment. So a couple of things we've been doing and working with clients with on that front is to look at ways to diversify the fixed income. So duration management has really been the only key this year, right? Spreads haven't really widened or contracted, so that hasn't provided a big opportunity to have better returns. But if your duration is shorter than some of the Barclays aggregate, which is about 6.5 years, there's some opportunity there to shorten up your duration. So we're looking at putting, about a third or maybe 30 to 40% of the fixed income into different type of opportunistic strategies given the current market environment. Equity market's been difficult, right? If you look across the spectrum in the middle, down, call it 16% to 20%. So not a lot of place to hide there. There's some active management benefits you can get. Value's been a better performer than growth so far this year. And some of the multiples are starting now to move more in line with his historical averages. So might be some buying opportunities there, but not really unless you're trying to avoid and be tactical and go cash versus equities, which we don't advise. Not a lot of opportunity to miss some of the downturn on the equity side this year. But if you move out to the right, there are some opportunities within real assets, kind of a broad bucket of infrastructure, kind of other inflation sensitive assets, been down, call it 5-ish%. So hasn't missed everything, but, has done okay relative to other asset classes. And then marketable alternatives for plans that get big enough in size and liquidity is not a big concern. Those have been down about 3%. So maybe some alternatives can add to some of the diversification benefits within the plan. All in though, as I mentioned, fixed income is a lion's share of these market rate cash balance plans. So that's been a difficult start, right? One of the worst bond markets we've ever seen to start this year. See that blue line there? You don't want to see it going down below the rest of the observations. We'd like to be in the middle or on the top end there. But if you were able to diversify some of those investments in the bond world, instead of looking at maybe down 10-ish%, maybe down more around the 6% range. And then on the equity side, again, a similar down 15-ish% is something to be expected this year, but some opportunities to rebalance in those. As you look at the Fed raising interest rates, it's likely that the volatile interest rate and bond market is going to continue. So we're continuing looking at ways to invest those assets. The time period you have is always of utmost importance, right? So if you started the plan last year over the last 12 months, likely if you're in one of those investment strategies that I've been talking about, you're down over the last year, maybe 3 to 5% on a 12-month basis. So definitely have discussions of that cumulative floor and what to do with those participants. But then if you look out over 2 years, some of these portfolios still would have been annualizing somewhere in the 4 to 9% range. And again, over longer periods, 3, 5, 10 years, still within that kind of 5-ish% range. So the time of starting is always the big key within the investment framework. And that can make a big determinant of how your population, your participants are getting their cash balance interest crediting rate. But again, bond side has been struggled. You look at the next page, equities equally struggled, as I've talked about, but we do see over time, building in 30 to 40% into equities as bull markets or positive markets have tended to happen about 2/3 to 3/4 of the time we've been in positive territory. That's what we're looking at over long stretches, but those painful 12 to 14 month stretches where we hit bear markets of down 30% do tend to happen. They don't tend to happen recently as frequently as they had throughout the late 90s and early 2000s, but it's still definitely something that we're planning for within client portfolios. Some statistics to give you here on the why not to try to tactical. So if you were just to try to time the markets and you missed just the 10 best S&P days on those recovery days, you lose about 64% of the recovery that you would have had of staying invested. So again, not stick your head in the sand and just put a 60-40 mix out there, but be smart about it, rebalance. We're looking at client portfolios further diversifying on the fixed income side, and then bringing in some inflation adjusted real assets, and then also looking if there's a space for marketable alternatives. So those are some of the trends we see now, but can get into those a little further in the Q&A. I think we're going to turn it over to Erin now to talk about some of the regulatory things she's seen in the market.
Great, thanks, Brian. Nice to be here today. I just wanted to quickly review, if you could turn maybe to the next slide, the legal standard on which cash balance plans operate. Cash balance plans are subject to the Employee Retirement Income Security Act of 1974, also known as ERISA. ERISA governs the operation and administration of U.S. private sector pension plans, such as cash balance plan or 401k, as well as welfare benefit plans. And ERISA includes very strict and high standards with respect to fiduciary responsibility, administrative requirements, and it also includes liability and enforcement provisions. And so adopting strong ERISA fiduciary governance practices with respect to your cash balance plan can go a long way towards limiting liability in connection with fiduciary decision-making, limiting the number of potential defendants, and promoting efficient plan administration. Next slide. So a person is a fiduciary and subject to ERISA's fiduciary standards to the extent he or she has any control over the management of plan assets, is responsible with respect to plan administration, or renders investment advice to the plan for a fee. Next slide. And ERISA includes the highest standards of prudence known under the law. And so fiduciaries have the responsibility to act prudently, solely in the interest of plan participants and beneficiaries. There's strict rules with respect to what types of expenses can be charged to the plan and what need to be paid by the company or plan sponsor. ERISA also mandates diversification to avoid large losses and compliance, of course, with the plan documents. So next slide. ERISA is a strict liability statute, and there is exposure under ERISA. Fiduciaries can face even personal liability for losses. So, of course, most fiduciaries who serve in this role are indemnified by their companies. There's also significant, lengthy co-fiduciary liability provisions. Participants and beneficiaries can sue. We have in this country an extremely active ERISA plaintiffs bar. And also, the Labor Department can also get involved with respect to audits and investigations with respect to compliance practices. So next slide. This is just a brief summary of what ERISA prohibits. Some of them should be natural, or intuitive. It prohibits self-dealing, very strict conflict of interest rules, as well as kickbacks. So, for example, a fiduciary can't use his authority over plan assets to make more money for itself. There are also essentially prohibitions really on virtually any financial transaction with plan assets unless the fiduciary or manager or service provider to the plan complies with a number of enumerated exemptions. And so compliance with those terms and conditions is very important, and it's important that your service providers to the plan are aware of these exemptions. Next slide. So there are a number of activities and decisions that are subject to ERISA's fiduciary standards, which I'm going to quickly go through in the next slide. But there are also decisions that are not subject to ERISA's fiduciary standards. And these are what are deemed to be set law or plan sponsor or design, for example, decisions. So a decision whether to establish or terminate a cash balance plan is not subject to ERISA's fiduciary standards. A decision to amend a plan is not subject to ERISA's fiduciary standards, or considerations with respect to plan design. So determining interest crediting rates, as Brian just reviewed, is also not deemed to be a plan design decision and not subject to the ERISA regime. So it's important for folks to recognize and understand, again, which decisions are set law, fall into the set law category, and which fall into the fiduciary category. Next slide. So this slide summarizes common decisions that are required with respect to a cash balance plan that are subject to ERISA's fiduciary standards. And they can really go into two buckets, what I refer to as administrative decisions, which are subject to ERISA standards, as well as investment decisions. So what would be an investment decision that a company may make with respect to its plan? The most important decision you'll make probably is to, an investment manager, selection of an investment manager, and going through a diligence process and documenting that diligence process. How experienced is your manager with respect to cash balance plans? What is their performance? Are the fees reasonable? So those are, common considerations with respect to selecting an experienced manager. Is a manager familiar with the ERISA compliance, issues, exemptions, bonding requirements, and so forth? So that, a fundamental decision that needs to be made. Selecting an insurance or annuity provider is also subject to ERISA's fiduciary standards. So when participants hit retirement age, they may annuitize, and selecting that annuity provider, again, is subject to the ERISA standard. Other decisions may fall more into the administrative realm. ERISA includes disclosure requirements, deciding appeals, processing claims, maintaining good records. So that is also subject to ERISA's fiduciary standards. Hiring an actuary, checking into and looking into what assumptions the actuary may use to convert traditional forms of benefit into optional forms of benefit, such as a joint and survivor annuity, for example, is an important consideration. Administrating spousal consents, believe it or not, there's case law that subjects proper administration of these consents is also subject to the fiduciary standard. And so, these hiring, for example, a law firm to draft your plan, and ensure the tax qualification of that plan. For example, you should file, in my view, a determination letter with the IRS it's kind of the rubber stamp of approval from the regulators that the plan complies with all of the litany of rules under the code. And I think I just want to leave you before I hand things off to Dennis, is with respect to all of these service providers, it's important nowadays to ensure that they have good cybersecurity and cyber liability insurance. The Labor Department last year gave guidance in April, actually, of 2021 for plan sponsors. And that guidance includes a list of diligence questions that you should be asking of all of the plan service providers. Do they have adequate insurance? And what are their policies and processes with respect to protecting important information and data with respect to the plan? And what are their policies with respect to if there is a data breach? So the Labor Department earlier this year has stated informally that it is a top enforcement priority to ensure that plan fiduciary committees and companies are looking into these cyber practices. And we've now been seeing these cyber security questions as a routine part of audits, Labor Department audits and investigations. So on that note, Dennis.
Erin, thanks. And kind of what I want to jump into is really kind of touching on some of the key benefits of these types of plans. Certainly the slide you see here is a cash balance plan right for you. There's a lot of great benefits. There's a lot of key considerations. It's a qualified plan. And I tend to spend a lot of the time with our plan sponsors, helping them understand, right, what some of these key considerations are. For today, I do want to really hit on what some of the key benefits are. And as we kind of go to the next slide, really kind of what Kate had started with, right? What is a cash balance plan? It looks and feels a lot like your 401k profit sharing plan with a lot of higher limits. This table here really reflects, what some of those opportunities are depending on your age. At the start of the cash balance plan, right? Those that are younger, you'll see, right? Maybe having an opportunity of a benefit of up to $88,000 within a cash balance plan, a total of near $150,000 between the two retirement plans that are out there. Those closer to retirement, again, another $272,000 on top of the $67,500 that's out there. So very significant limits or additional dollar amounts that are available, for those that want to do a cash balance type of arrangement. When we go on to the next slide, really looking at optimization within a defined benefit or cash balance plan. A lot of the clients want to understand what that looks like, right? So Kate had also mentioned, right, who are these plans a fit for? I would first start out, right, professional groups, those with shareholders, those with compensation $400,000 or north of that, right? A good number of folks within that area. Those are prime candidates for a cash balance type of arrangement. But more specifically, are you providing a 5% profit sharing contribution to your staff, right? As an example, that's a start. You have to have at least a 5% profit sharing going to the staff. Ideally, you have a 7.5% contribution going to your staff. If I start with the fully optimized approach here on the right, we're taking a look at the 67,500 that's available in the DC plan. A 50-year-old shareholder, professional, has an opportunity of another $171,000 going into a cash balance plan for near a $250,000 contribution tax deferred going into one of these retirement plans. What's key about that is you need to be providing a 7.5% minimum profit sharing contribution to those participants that are eligible within your defined contribution plan. Some plans, maybe not providing that high of a contribution. Maybe they're providing 5 and not quite 7.5. So that optimized approach still can happen, So if you're providing at least 5, but less than 7.5, you still have a lot of opportunity available to you on the cash balance side at $71,000. The amounts are certainly lower within a 5% contribution, but still significant, More than double what you're getting in the 401k side. The regulations were changed 10 plus years ago to really encourage plan sponsors to give at least 7.5% to your rank and file participants to encourage those higher levels to the professionals that are out there. So I would leave you with that thought, As long as you have a 5% commitment, but ideally 7.5, there's a lot of very favorable optimization that's out there. If you just have a DC plan in place today, that's 67,500, You're basically taking advantage of 27% of what you would have available on a tax deferred arrangement within a cash balance plan. So again, I think this really represents the key attraction to plan sponsors looking at cash balance. In closing, if I go to the last slide, what I would leave you with, probably 5 key things that you need to look at to have one of these plans run. You need trust custody, you need actuarial services, you need administrative services, Those are things that Schwab can prepare and works with their plan sponsors on. The plan design support things I'm talking today will be a fit. We work with their sponsors all the time on that. In terms of the outside, the legal advisory, the plan document, those are the things that Erin talked about today. Somebody like her, would be able to provide that legal advice, prepare that custom document. And then from an advisory side, managing those investments, That's what Brian had talked about. Certainly somebody outside, for example, at Schwab, would manage those outside assets. So really a great opportunity in terms of tax deferral, qualified plans, really the best protection you can get with any additional dollars that you're looking to save. So with that, I'll kind of pause there, turn it back to Kate for any Q&A that may have come in.
Okay, great. Brian, Erin, and Dennis, thank you so much. That was, I think, a lot of really great information packaged in and hopefully a very efficient delivery for those that are watching. We have a few questions that I'd just like to hit on briefly. And Dennis, I think the first question is for you. It's with regards to some of the plan design features of the cash balance plan, and particularly what are some of the eligibility and investing options for cash balance plans?
Yeah, great. Kate, that's a great question. And typically, that'll be largely dependent on what your profit sharing arrangements are. You're aggregating both of these plans together for testing, so it can't be more favorable. So if you have a 1-year requirement on the profit sharing, you'll have a 1-year requirement on the cash balance. From a vesting side, the same thing, If you had like a 3-year schedule on the profit sharing, you couldn't immediately vest cash balance because there's going to be some benefit features issues there. So whatever your vesting schedule is within the defined contribution plan will likely dictate what your arrangement's going to be on the cash balance side because they're going to be aggregated.
Okay, great. Thank you. Very, very helpful. Erin, a question for you with regards to taking a lump sum from a cash balance plan. What are some of the fiduciary considerations that plan sponsors must be aware of when it comes to rollovers for that lump sum benefit, and how can plan sponsors protect themselves?
Right, that's a great question. One, there are new regulations this year that went into effect. Basically, service providers that advise participants in your cash balance plan with respect to rollover recommendations are subject to a best interest standard under ERISA, and this exemption lays out requirements of how these service providers need to document that they made a best interest recommendation with respect to rollovers.
Okay.
So the service provider, the advisor, needs to understand the plan, what the guarantees are, what the interest crediting rate is, and really, make this, give advice that says, yes, and it needs to be substantiated that rolling to, for example, an IRA, which is much higher risk, yes, but potential perhaps for higher returns, is more beneficial to the participant than staying within the plan or, taking that lump sum and converting it to an annuity, for example. So this new standard is in effect. Companies should be aware of it. Any service provider that has a program and being able to speak to participants individually, you need to be cognizant and ask diligence questions that they will abide by this exemption. It's called 2020-02 with respect to any advice recommendations. Some advice providers, because compliance with this new exemption is expensive, will say that they'll rely on education. Well, it's very sometimes a gray area in terms of what is education and what is advice and investment advice. So that is a kind of a risky line to draw, because of course, plan participants who may not be as knowledgeable may rely upon that service provider really for advice when the advice provider thinks it's only providing education. So really, ERISA has a 5-part test in terms of what is deemed to be investment advice. The Labor Department has vowed that they're going to revise that test and make it much easier to fall into the ERISA fiduciary advice realm. So these are things to be aware about from, an enforcement perspective. The Labor Department is suspicious of rollover practices and advice being given to individual participants in this area.
Okay, great. Thanks, Erin. Yeah, tread lightly, I think, right, on this area. And we are a bit over time, but this question I think is an important one that came in on Brian. Thinking about terminating a plan and restarting as a strategic restart, especially in an environment where we've seen some pretty severe negative returns. Can you just quickly comment on that, and then we'll close it out for our participants here.
Sure. Yeah. Dennis or Aaron would be better to follow up on kind of the determination letters and all of those types of things. But strictly from an investment perspective, kind of depends on when you put the plan into place, right? A lot of these plans were started in the, call it 2013 through 2017 timeframe. So they've got a built up a big enough kind of buffer as far as cumulative returns that are positive. Those new plans that started last year that maybe are dipping into negative territory, they're just starting out. So they're not really thinking about, term restarts, but where they are thinking about is, what do you do if somebody's below water, so to speak, at the end of this year. Most of them in our discussions are keeping with their contribution tables. So they're not going to overfund or underfund based on some of that. But yeah, it's a consideration. Like I said, most of these are built for longer term strategies, call it 7 to 10 years. So the thought process is that markets go in and out of cycle, over a 12, 18, 24 month period, you get back to positive performance as markets recover. But yeah, definitely considerations to think about if this year continues to be negative. What can you do with balances that you're rolling people out of that are below water, bringing them back to whole is what you need to do. But then as a plan, you're still kind of functioning as an ongoing basis.
Great. Thanks, Brian. And Aaron, Dennis, Brian, and thank you for joining this today's panel, and for all the attendees as well. We will have a recording of this session available on our website, fiducianadvisors.com. Thanks for attending, and have a great day.